Do you know what these 6 people have in common? They all became very wealthy investing in dividend stocks. In this video, I will give you 10 reasons why dividend stocks are definitely worth it. At the end of the video, I will tell you exactly where to find those dividend stocks. Besides that, I will also give you an update on my portfolio and one purchase I made. If you're new to this channel, and most of you probably are, don't forget to subscribe to my channel and turn on the notifications by hitting the little bell next to the subscribe button. You can do that by clicking on the subscribe button below on the right side below this video. The biggest reason I buy dividend stocks instead of regular stocks or index funds is the constant stream of cash flow coming in. I like the idea that you don't have to sell shares in order to generate cash flow. This comes in handy, of course, also during retirement because you will keep your principal and still you're generating sufficient income to be able to live off. Of course, it depends on your goals, but I would never like to sell my principal. Compare it to a rental house that you would have to sell. Yes, you generate cash flow from that sell, but after that sell, you won't have any more cash flow coming in the form of rent for you. So let me give you a quick example of how that works in practice. Here's the dividends coming into my account. And this is a short overview of both 2018 and 2019. And as you can see, there's dividends coming in beginning of January, then in February, then again in February, another one in February, and then in March, 5 times. If we go more recent, some more in May, 2 more in June. And as you can see, the amounts are not that big because my amount of shares is not that big yet, but you get the idea. And this is only a stock portfolio of 9 stocks. Imagine if you have 25 stocks. This constant flow of cash coming into your account is even bigger. That is what you will see over time on this YouTube channel as well, as my portfolio and my amount of stocks will grow. Now, as number one was one of my personal reasons why I started investing in different investing stocks, this one, compounding, is one of the biggest reasons why wealthy people are wealthy and how you can get wealthy as well. And compounding is basically that you're receiving interest on the interest you received. So compounding occurs when the interest payments, the dividends, are reinvested and you earn interest on the original principal and those new interest payments. If you keep repeating this process of reinvesting your dividends, the effect will grow stronger and stronger as long as you keep reinvesting those dividends, and you will earn more and more interest because the principal will grow bigger and bigger. So let me show you quickly why reinvesting versus not reinvesting makes a huge difference. And that is caused by the compounding effect. So if we first calculate without reinvesting, also known as a simple return, and we look after 20 years, we can see that with an investment of 10,000 and a monthly addition of 500, assumed dividend growth rate of 6% and assumed starting yield of 3%, and assumed growth rate of share price of 6%, that the portfolio value after 20 years is just shy of $34,000. If we then go back, set it to reinvest for those 20 years, calculate again, we will get the compounding effect, and we'll show clearly here after 20 years you can see that the portfolio has now grown to 404,500. So that's a huge difference. And what's more, after 20 years, you can see the annual income from dividends is almost 11,500. If we then go back to the previous calculation without reinvestments, we can see that after 20 years, the dividend payments are not even $1,000 annually. Now, as I invest in dividend stocks that not only pay dividend, but they also regularly grow their dividends, I have put in the dividend growth rate in previous calculations, but if I now remove that rate, let's see what the result of that is. So after 20 years, we only have a dividend income of almost $3,000 instead of the $11,500 that we saw in the previous calculation. And the portfolio value is also less. It's 336, almost 337,000 instead of over 400,000. So what this clearly shows is that the compounding effect is huge, and this is only over 20 years and with very mediocre assumed rates. because I just took the averages of over the last decade for the dividend growth rate. I took a very modest assumed growth rate of the share price. Of course, there are other factors are the initial investment and the monthly additional investment. So if you can bump up your monthly additions, then of course this effect will be even greater. And then number 3, frequent dividend raises are a sign of profitability because companies can only sustainably raise their dividends periodically if they are increasing their profits as well. Otherwise, it is not sustainable for a company to keep raising their dividends. And a way to measure the sustainability is the payout ratio of a company. If the payout ratio is too high, I usually use cutoff of 70%. Above 70% is too high. Or if the payout ratio is rapidly increasing along with the dividend increases, that is a sign that the company cannot keep up with the frequent dividend raises. Companies that can raise their dividends and keep their payout ratio at sustainable levels show that they are profitable and that they are stable companies as well. So companies that have raised their dividends for 5, 10, 25 or even 50 years have shown to be very reliable companies to invest in. Like I said, companies cannot fake their dividends because it's real dollar amount they have to pay out to their investors. And then number 4, almost halfway there, dividend stocks tend to hold up better during a recession. And that's because dividend investors are usually long-term investors. People tend to flee to safe dividend stocks during recessions because they provide some safety haven. Of course, there are also dividend companies that had to cut their dividends during a recession and the streak was actually broken. One thing to keep in mind, when a company does cut its dividends, sell it as soon as possible. At least that's one of my rules. If a company cuts its dividend, then sell it. Don't wait, sell it, because usually after one cut comes another, and a company with a long streak of dividend increases won't just cut it because it's not doing so well for just a short amount of time, but that's usually a sign of an underlying problem that might emerge later as well. So let's take a look at one of the most pristine dividend growth companies out there, which is Johnson& Johnson, and let's take a look how it performed during the recession of 2008, 2009. So what happened to Johnson& Johnson during the Great Recession of 2008, 2009? The recession started in the summer of 2008, so let's take a look at that. So here Johnson& Johnson paid out its regular dividend in August, then again in November, and again in February of 2009. And then it actually increased according to the regular schedule in May to 49 from 46. So as you can see here, they just kept raising their dividend, kept raising until now. So in this dividend chart, you cannot see any sign of a recession, and that's a sign of a good dividend company if they kept raising their dividend during even one of the greatest recessions in history. And what if we look at the price chart? So again, if we go to 2008, right around here, 71, and then of course the price did go down, but like I explained in my previous video, we do not care so much as dividend investors about the price fluctuations because during all this time, as I just showed you in the dividend growth history, Johnson & Johnson kept paying out their dividends and they even kept increasing their dividends. And that is one of the greatest advantages as well of investing in dividend growth companies. And then number 5, we're halfway there. Dividends are taxed at a lower rate. Now, I'm not a US citizen, so I cannot say much about the tax system in the US, but what I do know is that also in the US, dividends are taxed at a lower rate than, for example, bonds or capital gains, because they are taxed according to your income bracket. But what I can say that as for the Netherlands, where I'm from, it is even more tax efficient because yes, you have to pay 15% tax on dividends as well, but is deductible when if you have over a certain amount in savings or securities, then you can deduct it from that tax. And then on to number 6, you can be paid in two ways. And actually, most of the time you will be paid in two ways, and that is in the form of dividends and capital appreciation, which makes up for the total return of the stock. So you're essentially paid for holding the stock in a way of dividends, and on top of that, most likely the stock will increase as well, especially if the stock is raising their dividends regularly, because that means the stock becomes worth more for other investors as well. And as the stock market is a market of supply and demand, if there's more demand, of course, the price will go up as well because the stock is more valuable to investors. And like discussed before, profitable companies raise their dividends. If companies keep increasing their dividends, their earnings are most likely also growing. Otherwise, it is not sustainable for a company to keep raising their dividends. So the company actually becomes more and more valuable, causing the stock price to rise with it. But all too often, this does not have to be in similar fashion. So there can be a lot of noise in between, but long term, the stock price should follow the profitability of a company. So another example of such company is Visa, ticker V, which is actually a company that is growing very fast, and with it, the dividends are also growing very fast. They have been raising their dividends since 11 years now. So as you can see, right after the end of the financial crisis, they started raising their dividend. So they actually went up from 0.03 until now 0.3, almost 27 cents increase in dividends. Now I have to say that the initial yield of Visa is not that high. So this is the current yield of around 0.60. If we then go to a holding period from 2008, the yield on cost is actually 7.8. But that is not the whole story, because this advantage was about being paid in two ways. So over to Google Finance now. If we again go to like end of 2008, from $11.60 until now, the stock price has gone up 1500% to 182. So if you had invested in 2008, and of course that's with hindsight, because at that point you might have not known that the company would perform so well. This is a good example that you are not only paid in dividends, which for Visa is not that high, but they are raising their dividend aggressively. That you can see that you were not only paid in dividends, but also in capital appreciation. So your total return on this stock would actually be pretty high. I would have to calculate it. I think the example here is quite clear. And just to show you the dividend growth rate of Visa, you can see that the average 10-year growth rate is 25.3%, which is very, very impressive. Most companies cannot keep that up for such a long amount of time. And if we then look at the payout ratio, their payout ratio is actually below 20%, which again is very, very low. So they're only paying out 19.35% of their earnings in dividends. So they have a lot of room to grow their dividends still. And that is why for a lot of dividend investors, Visa is a must in their portfolio. Now here another example, which is a bit of a different company, because this company is a lot bigger, a lot more established already than Visa was before. And their dividend growth history is actually pretty long as well. It's over 50 years. But if we take a look again at the period in 2008, end of 2008, you can see that they're still paying out their dividends. And what a surprise, beginning of 2009, they increased their dividend. It was not such a big increase, but still, they kept increasing their dividends. 2010, same story. 2011, all up until now. And as you can see, it went from 50 cents in 2008 to $1.44 in 2019. Now again, if we look at the price appreciation during that time, let's take August 2008 again, from $73 until now, it is at $180. So it is up 100, almost $107, and up 145%, even though, as you can see here, it has taken a huge dive, minus 30% since 2018, beginning of 2018. It is still up by a large amount. And all that time, again, they are paying out dividends, increasing their dividends. So these are two great examples of why I invest in dividend growth companies. And then number 7, almost there. Dividends can offset a short-term capital loss. It is kind of what I showed already in the previous video as well with Qualcomm. So I'll give you a short example again of how dividends can ease, let's say, ease the pain and offset short-term capital loss. So if again we take a look at 3M, during the Great Recession of 2008-2009, we can see, and it actually began earlier already for 3M. Let's say the high is around July, and then if we take a look until March of 2009, you can see there was a 53% capital loss during that period. But during that time, as we also saw in the previous reason why to invest in dividend stocks, they kept raising and paying out their dividends. And then if we go back, we can see that it actually recovered after the Great Recession had ended and it went up and up and up. But if you were not getting paid in dividends, you had to wait almost 4 years before it turned profitable again. But because you were getting paid dividends, and of course it depends on when you started investing in 3M, you were still receiving income and you were not forced to sell your shares during that period to get your income. Number 8, dividend stocks are also inflation resistant, meaning good dividend growth stocks keep up with inflation. According to inflationdata.com, the average inflation from 1919 until 2018 was almost 2.5%. And if we take a look at the dividend growth rate of, for example, 3M, which we also used in the previous two examples, you can see that the 10-year dividend growth rate almost 11%. So that is definitely way better than inflation. So you're essentially protecting yourself against inflation when you buy dividend growth stocks that are raising their dividends at a higher pace than inflation. And then number 9, you get an immediate return on your investment. As soon as you purchase a dividend stock, and you go through the ex-dividend date, you are eligible for the dividend payment. So you will get paid straight after. So you will get paid straight after the payment date has passed. Let me show you this with an example of a company I bought, CVS, on the 29th of August in 2017. And then I got paid my first dividends from CVS on the 3rd of November 2017, $2.75. So I get an immediate return on my investment. Well, it's not immediate, but you get the point. I don't have to sell any shares to get this return. Number 10, the last reason why investing in dividend stocks is worth it. It saves a lot of stress and time because you don't have to do research all the time like you would with trading, for example, because you're investing mostly in blue chip stable companies, because those are most likely the companies that are paying out dividends. You're only researching them before you buy them, and then, of course, periodically you check how they are doing, but you don't have to check the stock market every day. And to stress how important this point is, let me show you the graph of 2019, which was generally considered a good year. As you can see, this is not entirely 2019, but it's from the 11th of January until now. It went up 26%. But if we go in between, we can actually see here from May, beginning of May until the end of May, it went down 6.5%. Again here, from 26th of July until beginning of August, it went down 6%. So as you can see, it is never, the price of the stock market is never in a straight line, even though it went up 26% in a year. So if you would keep looking at the stock market every day, you would get very stressed from those daily losses if your only interest would be capital gain. And because I'm not looking at the stock market every day, because I know I will receive my dividends if I did my research right, I don't experience this kind of daily stresses. And as research has shown that you as an investor are your own worst enemy, that your emotions are your own worst enemy to getting great returns over the long term, this is a very important point. By now you're probably thinking that's all great, but where can you find those dividend stocks? Well, let me show you. If you go to the website dripinvesting.org/tools, and I will also put a link in the description underneath this video, you can download the Dividend Champions Excel spreadsheet, which is a spreadsheet of all the companies that have grown their dividends for at least 5 years and up. And this is what a list looks like. So there's a lot of data in here. Current dividend, amount of years they have raised their dividends, dividend growth rate over the 1 year period, 3 year period, 5 year and 10 year period, earnings per share payout, and there's a lot more metrics here. If we go to the Challengers tab, that's an overview of all the companies that have raised their dividends from 5 years until 10 years. And the Contenders tab shows all the companies that have raised their dividends from 10 years until 25 years. And then we have the Champions tab, which shows all the companies that have raised their dividends from 25 years and up. And this list was actually created by David Fish, which unfortunately passed away. And now it is maintained by Justin Law. What's great about this is that you have a lot of data in this list, and from there on you can make your own screener, like I did in here. So here I have an overview, for example, of all the companies which I think have a yield over 3% until 15%. Unfortunately, sometimes some of the data is not loading, but you get the point. So this is actually also what I talked about in the previous video, because I use the CCC list as a first bucket of stocks that I would like to do further research in, and then I usually make a broad filter for, well, you can see it, I put it on yield, earnings per share and return on equity, and earnings per share in the past 5 years, the dividend growth in the past 5 years, and all of the data is coming from the spreadsheet of the Champions, Contenders and Challengers list. So from here on you can do further research, but can get some great ideas from here. And actually some of my first purchases like T. Rowe Price I found using this process. And then the last part of this video, an update of my portfolio. Last time I showed you dividend payments until October, so now we have November in and December as well. So we get a broader view of all that came in. So it's just shy of $300 that came in, and you can actually see here the year-on-year changes. And as said before in the previous video, I haven't made any new purchases since 2018. So most of these in March, April, May are all purely from dividend growth. And if we then go to my portfolio, it is now at 8,311 euros, and that is down from last time because I took out the dividends and I put it in another broker, in DeGiro, which I will show you right after. And what I might have not mentioned clearly last time, the unrealized gains here are actually yearly gains. So this is from 2020. And then now on to DeGiro. And as you can see here that the total value of this account is now at 814 euros. And what you can also see is my latest purchase here, which is Tanger Factory Outlet Centers, or SKT as a ticker. And I bought it on the 10th of January at a price of 15 euros and 86 cents. I won't go into much detail right now about my reasons for buying it, but what I can say is one of the main reasons I bought it is because I think it's at deep value right now. And that actually concludes this video. If you like what you see, please subscribe. Don't forget to turn the notifications on by clicking the bell, so you will get a notification every time I post a new video. And please comment and like the video as well. And if you have any questions, please let me know. See you next time. Bye bye.